Hello everybody, welcome back for part 2 of our breakdown of the One Big Beautiful Bill Act. This bill had way too many important provisions and impacts on all of our tax returns and income taxes that we wanted to break this down into a couple videos just to make this digestible and easier to understand. So this is part 2. If you missed part 1, there is a link to that video in the description below, so please feel free to go back and watch that one. You can watch either one first, it doesn't really matter. The first video focused more on things that have not changed. There were a lot of tax provisions that were set to expire, and this act kept a lot of those going into the future, made some things permanent, and we focused more on those things and a couple small changes in this first video. In the second video here, we're going to talk about some pretty significant and meaningful things that have changed, and we'll dive into those here in this video. Again, thanks for joining us. Please keep in mind, we're going to be talking a lot about taxes. What you're hearing and seeing is for general informational purposes only. It's not tax advice or investment advice. Please make sure to talk to us if you're one of our clients, you're a tax professional, if you're thinking about applying any of what you're hearing to your own personal tax and financial situation. All right, a very quick recap for those of you who are watching this video first. The One Big Beautiful Bill Act is a massive bill. It's almost 900 pages, and that doesn't account for the thousands of pages of references to the tax code. So it's just a big stack of paper. And for most folks, the vast majority of those pages aren't going to end up impacting your tax return. Much of the bill focused on government spending, military spending, Social Security, funding Medicaid and Medicare, but a fair amount of it is focused on income taxes, and for our clients, many of those things are going to end up impacting potentially your tax returns even this year in 2025 and some things in 2026 and going forward. So we're going to try to simplify those things and actually pull out what's really relevant to most of our clients, all of you. So if there is anything proactive to think about or do, you know where to focus. And obviously we're here to help our clients through those things and to think through those changes as well. It's important to know that some of these changes in the bill are temporary and have a short period of time to be around, at least temporary for now. And some of these are permanent changes. I'll make sure to highlight which of these are temporary, which of these are permanent, and when they start. Some of these new provisions start this year, and some start in 2026. So we'll make sure to highlight the year when they start, which are temporary, which are permanent. The IRS still has a whole lot to figure out. They kind of had this bill thrown at them, and they have to figure out how they're going to apply it and enforce it. So there's probably still a lot to come on these new provisions in terms of reporting, and all of these things are still up to be adjusted and changed as well, even though the bill has been voted and approved. Again, much of the bill doesn't impact all of our taxes and the taxes of many of our clients, but there are some really important things that we're going to touch on today. So let's go ahead and dive in here. I'm going to move myself out of the way. There we go. All right, first and foremost, the first two provisions that we're going to highlight touch on charitable giving and charitable contributions and the tax impact, the tax benefit of giving money to charity. So the first change is a change to the deduction of charitable giving for folks who are using the standard deduction. I'm going to break all of these down in terms of what are the current rules and what are the new rules going to be when they go into effect. So let's touch on the current rules for charitable contributions in terms of them ending up as a deduction on your tax return. Current rules are charitable contributions are an itemized deduction, which means that folks who itemize their deductions are able to include in their deductions the gifts that they give to charity, along with medical expenses over a certain amount of their income, 7.5%, State and local taxes up to historically $10,000. That has changed. We'll talk about that. And their mortgage interest. If those things add up to more than the standard deduction, then you would itemize. Back in the 2017, with the Tax Cuts and Jobs Act, the standard deduction was increased significantly, and it's increased since then. For a married couple filing jointly who are over 65 today, that standard deduction for 2025 is over $33,000, which means your itemized deductions, that list of things that you have there, would have to add up to equal more than $33,500 for you to itemize, for you to actually get a tax deduction for your charitable giving. Those who are taking the standard deduction and give to charity, they don't really get a tax benefit for their giving. Well, that's going to change effective 2026. Again, this is starting next year, not 2025. And this is a permanent change to the tax code where charitable deduction will be available on a limited basis for those who are taking the standard deduction. There was, I believe it was 2020, there was a very brief period of time, I think just for that 1 year, where there was a provision like this that has come and gone, where those taking the standard deduction could deduct a certain amount of charitable giving. So this is now a permanent change. And there is an annual maximum. So for single filers, that's $1,000 a year. For married filing joint filers, that's $2,000 a year. So that's up to $2,000 for a couple filing together of charitable giving that you can deduct even if you're not itemizing your deductions. This is not an additional deduction available to those who are itemizing. This is just for those taking the standard deduction, which means if anybody has been taking the standard deduction for a long time and hasn't bothered tracking or keeping receipts for charitable giving, starting in 2026 is a good time to get back into the habit of keeping those receipts, because as you submit those to your tax preparer or as you do your own taxes, you are going to be able to deduct up to a certain amount of those deductions, even if you're taking the standard deduction. So an important change to keep in mind for next year, for those of you who have gotten out of the habit of tracking your charitable giving because it hasn't benefited you for a while, you're going to want to track that giving starting next year. So a nice benefit for those who are taking the standard deduction and still giving to charity. You finally get to have some of that help you from a tax perspective. Number 2 here also focuses on charitable contributions. And this change is for those who itemize their deductions. This does not impact the provision we just talked about, the new deduction for those who are taking the standard deduction. This is for folks who are doing the itemized deductions and giving to charity. Currently, all charitable gifts are counted as an itemized deduction as long as the gift goes to a qualified nonprofit or charitable organization. There has not been any threshold of giving to reach before you can begin taking that deduction. So effective 2026, next year, a permanent change is you can only count as an itemized deduction charitable gifts that are over and above 0.5% of your adjusted gross income. This is similar to the 7.5% threshold for itemizing your medical expenses, where your medical expenses are only deductible when they are over, and the amount that is over 7.5% of your adjusted gross income. This is the same type of rule, but instead of 7.5%, it's 0.5%. So let's just walk through a really simple example of what that means. Let's say your adjusted gross income is $100,000. 0.5% of that is $500. So the first $500 of your charitable giving is not deductible. So if you gave $5,000 to charity that year, the first $500 is not deductible. The remaining $4,500 would be an itemized deduction that would add on to that list of other itemized deductions to determine whether you take the standard or itemized. So there is a small threshold to cross to start getting into deductible charitable contributions, which means that for most folks, a little bit less of your giving, again, depending on your adjusted gross income, is going to be counted as an itemized deduction. For most folks, maybe not the biggest change in the world, but could be meaningful, especially for those who have a high adjusted gross income and plan to give a fair amount. All right, change number 3. This is a change to the state and local income tax deduction limit from $10,000 a year to $40,000 a year, and then back to $10,000 a year after a period of time. So this is an increase and then a revert back to where we are today. This is a temporary change. These deductions are part of that list of itemized deductions, often called the SALT deduction, state and local taxes. So this includes your state income tax and your various property taxes and state sales tax as well. Historically, before the Tax Cuts and Jobs Act, there wasn't a limit. After 2017, there was a $10,000 cap put on the deductible amount of these taxes. So that $10,000 starting in 2025, this year, that limit's going from $10,000 to $40,000. And that $40,000 limit is for single filers and married filing joint. It's the same across the board. You don't get $80,000 if you're filing jointly. It's $40,000 for everybody. There is an income phase-out range for this increase in the deduction limit, which begins at $500,000 of modified adjusted gross income. So if your modified adjusted gross income is over $500,000, that $40,000 begins to go down. Your cap goes down until you're phased out completely. I don't know exactly where the top end of that phase out range is. It might be 600,000, but I'm not 100% sure. If you are completely phased out, you make too much money for that $40,000, you go back to the $10,000 limit. It doesn't go away completely. It just goes back to the old limit, which after 2029 will be our new limit. That $10,000 is set to be the new cap in 2030. This is a relatively short change. Revert back for the 2030 tax year. So this has a significant potential benefit for residents of states with high state tax, like New Jersey and California and New York. Certainly a meaningful consideration for those folks. Also meaningful folks who have multiple properties and are able to hit that $10,000 cap just based on property taxes. So benefits folks who pay a lot in property taxes, pay property taxes on multiple properties, and can really take advantage of that full or close to the full $40,000. Pennsylvania doesn't have a significant state income tax. The state income tax is 3.07%, so we're not in a state with high state income tax. But there are other ways Pennsylvania residents can use this, especially on the property tax side of things and potentially the sales tax side of things as well. A planning consideration, and there's more than one here, but one to highlight is those of you who are close to or over that $500,000 adjusted gross income limit. We're going to want to think of ways that we can lower that to get out of that phase out range and use the full cap, even if it's for a temporary period of time. And there's a couple different ways that you can manipulate intentionally your adjusted gross income to get under that limit, even if it's just for a couple of years. So I know we have clients that we're going to talk with about that, talk with their CPAs as well, and see what we can do to get them to reap all of the rewards of this temporary increase in deduction and save some tax. Change number 4 here, I'm going to go through it kind of quickly. I don't think many of our clients are using the federal marketplace for health insurance created by the Affordable Care Act. Some pretty big changes there, though, under this provision for those who are using it. Just a really quick summary for those folks who do not have health insurance through work and buy health insurance through the Affordable Care Act marketplace. If your income is below a certain level, you can qualify for reduced premiums through premium credits. And there's a range of income based on the federal poverty level that you can qualify for these reduced premiums. Right now, that metric is around 400% of the federal poverty level based on your household size. So right now, if you are over that 400% limit, there's a gradual drop in your premium credits. They don't stop just because you're $1 over that 400% of the poverty level. You can still qualify. It would just be less premium credit. So a lot of people benefit from that right now who are even earning pretty good money. You can still qualify for premium credits on your Affordable Care Act health insurance. Starting next year, that 400% federal poverty level is going to be a hard line in the sand that going over that by $1 disqualifies you from premium credits across the board. There's no gradual decrease in the premium credits. You are disqualified by going a little bit over by any amount of that amount. So there's going to be a lot of folks who are over that 400% of the poverty level, and they're going to see potentially significant increases to their premiums because they do not qualify any longer for those premium credits. Those who are in that income range of $80,000 to $100,000 are potentially going to be hit the hardest with higher premium increases because they're right at that cliff level. We won't go too much more into the details here other than it's important for folks who are getting their insurance through the marketplace to think about and plan for and look into how this is going to impact them, because it could be a pretty significant premium increase, especially if you're in that range of income there. All right, on to number 5 here, which is a temporary exclusion of income tax on tips and overtime. This has been a pretty well documented provision of this act. There's been plenty of talk about tax-free tips and tax-free overtime for a while now as this bill was working its way through Congress. So let's talk about how this is going to look. As you will notice here, this is not a permanent change. This is a temporary 2025, this year, through 2028 change to the taxation of tips and overtime. We'll start on the left-hand side with tips. The $25,000 of income from tips are excluded from federal income tax, and that's per person. There's probably going to be more to come from the IRS in terms of getting a more clear definition on what qualifies for tip income. Tips can be kind of a gray area, and I'm sure the IRS is going to want to be able to enforce this. So we're probably going to get a more clear picture of what does tip income actually look like. I know we can all think in our heads what it probably means, but the IRS is going to want to be very clear about which type of income qualifies and does not qualify as a tip. This income tax-free tips is a phase-out range. For a single filer, that phase-out range is $150,000 to $400,000 a year. So for everyone single filer under $150,000, they can exclude the full $25,000. That excludable amount then goes down as you work your way from $150,000 to $400,000 of adjusted gross income. The married filing joint range is $300,000 to $550,000. These are pretty broad and generous ranges. A lot of folks who earn tip income are probably going to qualify for most, if not all, of that $25,000 limit. But those are the phase-out ranges. And then we have a very similar provision for overtime pay. Works a little bit differently, where overtime pay of $12,500 is excludable for a single filer and $25,000 for a couple filing jointly. So that's different than the tips. The tips are $25,000 per person. So for a married filing joint household, that's, if they both earn tip income, that's $50,000. Here it works a little bit differently. And there's the exact same phase-out ranges as tips. So those two phase-out ranges there at the bottom of the slide apply to overtime pay as well. And I'm sure we can expect more clarity to come out from the IRS on what constitutes overtime pay, considering how easy it will be to abuse the definition of overtime. Number 6 here is a temporary $10,000 deduction for auto loan interest. Right now, there is no tax deduction, itemized or not, for interest on auto loans. Starting in 2025, this tax year, going through 2028 tax year, for auto loans that are taken out in 2025 or later, so those of you that had bought cars in 2024 and previously, you're out of luck. For those who will buy cars in 2025, this applies to you, or 26 through 2028. The car must have its final assembly done in the US. So this will probably be something, if you are in the market for a vehicle this year, I'm sure at the dealership, you will be learning which cars had final assembly in the US from the dealership to help you figure out if there's going to be a tax deduction for the loan you may be taking to buy this vehicle. But the final assembly must be in the US. It does not mean all the parts have to be made in the US, but the final assembly has to happen here in the United States. This $10,000 deduction is completely separate from standard deductions and itemized deductions. You can itemize and take this deduction. You can take the standard deduction and do this on top. This is above and beyond the standard and itemized deductions. And again, as is the theme, there are income phase-out ranges, which are relatively tight ranges, as opposed to those for the overtime and tips that we just saw, which are pretty high and pretty broad. These are pretty tight, where for a single filer, that phase-out of this deduction begins at $100,000 of adjusted gross income and ends at $150,000 of income. So those single making over $150,000 in adjusted gross income cannot take advantage of any of this deduction. And the same goes for those filing jointly with over $250,000 of adjusted gross income. Again, car has to be bought in 2025 through 2028. Must be its final assembly done in the US. And that $10,000 deduction is separate and on top of your standard or itemized deductions. That brings us to the end of our video. These are the final 6 impactful and meaningful provisions from the One Big Beautiful Bill Act that we feel are actually going to have a meaningful impact on some of our clients. If you have questions about how any of these provisions, or those in part 1, if you watch that, how they impact you, if there is strategic planning that you should be thinking about, please let us know. We'll be thinking about this for all of our clients as well. And if there's anything we need to adjust or change or plan ahead for to take advantage of these and to help you pay as little tax as possible and keep as much of your hard-earned money as you possibly can. Again, thanks for tuning in. Stay tuned for our next newsletter, which will be coming out in a few weeks. Take care.